If you're involved in the UK crypto space, you're going to want to listen closely. Getting your taxes right is no longer just a good idea, it's an absolute must. And today, we're going to walk through exactly what you need to know for the 2025/26 tax year, with a guide developed by the absolute experts at My Tax Accountant. So let's just jump right in. Okay, let's start with a big one. From 2026, the entire game changes. HMRC will get direct, automatic access to your crypto transaction data from all UK exchanges. I'll say that again, automatic access. This means honest, accurate reporting has gone from being optional to absolutely essential. Now, I know that might sound a little intimidating, but please, don't worry. That's precisely why we're doing this. This entire walkthrough has been arranged and developed by the pros at My Tax Accountant. Think of them as our expert guides today, here to make sure you can navigate all of this with total confidence.
So here's our plan. First, we'll look at why HMRC is watching more closely than ever. Then we'll break down the two main types of tax you need to know, capital gains and income tax. After that, we'll get into how to actually calculate your gains, demystify those tricky share pooling rules, show you exactly how to report everything, and then wrap up with your key next steps.
Right then, Section 1. HMRC is watching you. And look, this isn't meant to scare you, it's about being prepared. The era where crypto tax felt like a bit of a gray area, that's officially over. Understanding this new reality is your best first move.
And just look at the power they have. Yes, the automatic data sharing starts in 2026, but they can already request data from exchanges going all the way back to 2014. They have the Know Your Customer info you provided, your name, your address, everything. And they're already using it, having sent out over 65,000 warning letters. The message is crystal clear. They know.
Which brings us to a really crucial point. If you're sitting there thinking about some unreported gains from previous years, the time to act is right now. HMRC actually has a specific service for this, the Crypto Asset Disclosure Service. Trust me, going to them is always better than waiting for them to find you. The penalties are likely to be much lower. You do not want to wait for that brown envelope to land on your door.
All right, let's move on. At its heart, UK crypto tax follows two main paths, capital gains tax and income tax. And figuring out which path your transaction belongs on is the absolute key to getting this right.
It all boils down to a simple question. Did you dispose of your crypto or did you earn it? Disposing of it triggers capital gains. That means selling it for pounds, swapping it for another crypto, spending it on something, or even gifting it to anyone other than your spouse. Earning crypto, on the other hand, triggers income tax. That's things like getting paid for a job in crypto or receiving staking rewards, mining rewards, or some types of airdrops.
And here's a little pro tip that clears up a lot of confusion. Not everything you do is a taxable event. Phew, just buying crypto with pounds? Not taxed. Holding on to it, hodling? Not taxed. And really importantly, moving your crypto between different wallets that you own? Also totally tax-free. It's only when you dispose of it or earn it that the tax man takes an interest.
Okay, ready to get into the practical side of things? Let's talk about calculating your gains. We'll dive into the essential numbers and the formulas you'll need for the 2025/26 tax year. So to figure out your gain, you have to know your starting point, and that's called the cost basis. All it is the total amount you spent to get your crypto in the first place. That's the purchase price plus any transaction fees. Getting this number right is the foundation for everything else.
Let's make this real. Meet Chloe, a freelance designer in London. She bought one Ether for £1,500. Later on, she sold it for £3,000. Her capital gain is pretty simple to work out. It's the £3,000 she sold it for, minus her cost basis of £1,500. That leaves her with a taxable gain of £1,500.
Now here's some great news. You don't necessarily pay tax on that whole £1,500. Every taxpayer in the UK gets an annual capital gains tax-free allowance. For the 2025/26 tax year, that allowance is £3,000. This means Chloe's £1,500 gain is completely covered. She pays zero tax on it. You only pay tax on the gains you make above that £3,000 threshold. So what happens if your gains are over that £3,000 allowance? Well, then you'll pay tax, and the rate depends on your overall income. For the 2025/26 tax year, if you're a basic rate income taxpayer, you'll pay 18% on your crypto gains. If you're a higher or additional rate taxpayer, that rate jumps up to 24%. HMRC just looks at your total income to figure out which band you're in. Okay, deep breath. We're now moving into what is without a doubt the trickiest part of all this. So stay with me, and this is where most people make mistakes.
We need to talk about the share pooling rules. This is HMRC's official method for calculating your cost basis when you've bought the same crypto at different times and prices.
You have to follow HMRC's rules in a very strict order. First, there's the same-day rule. If you buy and sell the same crypto on the same day, you have to match them together. Simple. If that doesn't apply, you move to the bed and breakfast rule. This is where you match your sale against any purchases of the same crypto you make within the next 30 days. And only if neither of those first two rules apply do you finally use the Section 104 pool.
So what on earth is a Section 104 pool? Just think of it like a big pot where you keep all your long-term holdings of one type of coin, say Bitcoin. You then calculate the average purchase price for everything in that pot. When you sell some, you use that average price as your cost basis. The reason they do this is to stop people cherry-picking, claiming you sold the coin you bought for the highest price just to reduce your tax bill. This rule forces everyone to use a fair average.
We're on the home stretch now. You've identified what's taxable, you've calculated your gains, and you've navigated the pooling rules. The final step is declaring all of this correctly to HMRC on your self-assessment tax return. And this is a massive change you have to know about. Starting with the 2024-25 tax year return, your self-assessment form has a brand new, dedicated section just for crypto assets. You can't just lump it in with other capital gains anymore. This is a huge signal from HMRC that they are watching crypto closely and require clear, separate reporting.
So what do you actually need to put in this new section? It's a few key totals: the total number of disposals you made, the total proceeds you received in pounds, your total allowable costs, that's your cost basis, and then the final figures, your total gains and any total losses for the year. The only way you'll have these numbers is if you keep brilliant records.
Let's quickly lock in those dates. The 2025/26 tax year runs from the 6th of April 2025 to the 5th of April 2026. And the really big one to remember is your deadline to file your return and pay your tax bill, January 31st, 2027. Put that in your calendar right now because you do not want to leave it to the last minute.
And now for our final section. Let's talk about your next steps. We'll quickly recap the most important takeaways so you can move forward with total clarity.
Here is your essential checklist. Number 1, acknowledge that HMRC can see what you're doing. 2, for every transaction, identify if it's a capital gain or an income. 3, meticulously calculate your cost basis and gains for every single disposal. 4, apply those share pooling rules in the correct order. 5, report it all accurately in that new self-assessment section. And underpinning all of it, the golden rule: keep detailed record.
Look, we have covered a lot, and it's completely normal to feel a bit overwhelmed by it all. The rules are complex, the record-keeping can feel intense, and the consequences of getting it wrong are real. But the most important thing to remember is that you don't have to figure all of this out by yourself. Now, just before we finish, a quick disclaimer. The information we've shared here is for general guidance only. Your personal tax situation is unique, so you should never rely solely on this to make financial decisions. It is always best to speak to a qualified professional for advice that is tailored specifically to you.
And that, of course, is where my tax accountant can help. For professional, expert guidance on your crypto taxes or any other tax questions, they are the people to call. You can reach them on 0208-570-8531, or you can email them at info@mytaxaccountant.co.uk. They will provide the clarity and support you need. And for more helpful content just like this, make sure you subscribe to their YouTube channel. Thanks for watching.